Think of trading the markets a bit like driving a car. To get where you're going safely, you only really need to keep track of two things: your direction and your speed. By the end of this video, you'll have a strict 3-step checklist that combines both of those elements to find high-probability trade entries. Let's get your dashboard set up. First, open your charting software and add an exponential moving average, or EMA. Go into your indicator settings and change the length for the EMA to exactly 50. Next, we need our speedometer. Add a second indicator to your chart, the stochastic oscillator. Adjust its settings so the inputs read 14, 3, and 3. With this specific 2-indicator dashboard in place, you can stop guessing what the market might do and start making objective, data-driven decisions. Step 1 of our checklist relies entirely on that 50 EMA line. This line dictates the overarching trend of the market. Think of it like a river's current. This chart shows how the price stays mostly above the blue moving average line. When price sits above the 50 EMA, you are in a strict uptrend. That means you are only allowed to look for buy trades. Conversely, looking at this chart, you can see the price candles fall below the orange EMA 50 line. That establishes a strict downtrend, meaning your rules only permit you to execute sell trades. The 50 EMA acts as a systematic directional filter. It keeps you on the right side of the current by only allowing trade entries that align with the dominant market momentum. Now shift your focus to the bottom of the screen. The stochastics indicator measures short-term momentum, telling us when that dominant trend is temporarily exhausted. On this chart, lines pushing above 80 into the red boxes mean the market is overbought and may soon drop. Conversely, lines dropping below 20 into the green boxes show an oversold market, signaling a potential upward reversal. It behaves like stretching a thick rubber band. Pull it too far and eventually the tension forces it to snap back. So while your EMA dictates the overall path, your stochastics pinpoint the exact moment the market is temporarily exhausted and primed to rebound. Let's put this into practice with a strict 3-step checklist for executing a live buy trade. Looking at this chart setup, step 1 is confirming our direction. We verify that the current price action is clearly sitting above the yellow 50 EMA line. For step 2, we check our momentum. Down at the bottom of the oscillator, we need to see that the stochastic lines have dipped completely below the 20 level into oversold territory. Step 3 is your trigger. You wait for the precise moment the two stochastic lines physically cross upward. Looking closely at this indicator panel, a common mistake here is impatience. You must wait to enter the trade until that physical line crossover actually happens, not just when the lines get close. By locking in all 3 steps, you guarantee your entry aligns perfectly with the dominant trend, catching the price right as a temporary pullback ends. But even perfect setups fail, which is why a stop loss is mandatory. It's the helmet you strap on immediately after entering any trade. For a buy trade, you place your stop loss just below the most recent low point on the chart. If you are executing a sell trade in a downtrend, you place that protective line just above the most recent swing high. There is one environment where this strategy will bleed your account dry: the sideways flatlining market. If price action is just chopping back and forth and the EMA line is flat and intersecting the middle of those candles, the strategy must be completely abandoned. Preserving your capital depends entirely on honoring your stop loss and refusing to take trades when the moving average lacks a clear, angled direction. Take a look at this chart to test your understanding with a quick rundown of a real sell setup. Step 1. The price is clearly below the EMA line. Step 2. The stochastic indicator is up in the overbought zone. And step 3. The line crosses downward right at the red arrow. The conditions are meant to execute a sell trade, and as you can see by the red dotted line, the stop loss is securely placed above the recent high. Before you risk any real capital, open your own charts, scroll back in time, and practice finding 5 historical setups that match these exact rules. Combining trend direction with momentum timing removes the guesswork, giving you a repeatable framework for identifying entry points where the technical